We have a big global voice now joining us. Dan Fineman is co-head of equity strategy at Asia Pacific at Credit Suisse, is with us now. Dan, great to have you with us here, back on CNBC TV18. Appreciate your time here, as always. Dan, let's just get the levels out of the way first, because this is becoming about the aggregate market and how much it has fallen and how much more there may be to go. So where do you stand on the S&P 500 and the NASDAQ, and if you were on the MSCI World Index as well? Are we in halfway through, more than that, or do you think we're just beginning? Your sense?
I think we have more downside. The story on rates hasn't completely played out. Clearly, people are expecting more rate hikes, but we think that markets will continue to be surprised by how high inflation readings will turn out, and also how much the Fed is going to have to hike rates. Even after the 75 bip hike, Fed rates are still in accommodative territory. We still have a ways to go to get to even neutral territory, and we think that the Fed is actually going to have to get into restrictive territory to bring unemployment up from current levels, which are too low.
Dan, hi, good morning. Will Asia be relatively resilient compared to the developed markets? Because even in India, we notice, of course, now the correction has become 18%. From the top, but so far it's not been as bad as what developed markets have seen. Do you think this could be the trend for the rest of the year?
I do. I think that Asia can't escape the headwinds from weaker global markets. Correlations with global markets are still high, but I think that Asia can outperform, though possibly on the downside, and be more resilient than particularly the US and Europe. What does Asia have going for it? Well, I think that earnings in Asia will be more resilient than in the US. We don't have the same wage pressures that they have in the US. The valuations in Asia are more appealing. We have low foreign ownership of Asian equities. There isn't that much loose money left in the region to be shaken out.
Well, Dan, you're fairly positive. I mean, a relative outperformance you expected from Asian markets. And I think a couple of markets that you're more bullish on is the Philippines as well as the Thailand index out there. And you have an overweight rating on China. But India is not finding a mention. What could turn around? I mean, what needs to change for India to get into that zone that you would be a little bit more positive on us?
Well, the two key negatives for India relative to other markets in the region are, number one, the valuations. The premium for India over the rest of the region, over global equities, is still unusually high. India generally trades expensive, but it's unusually expensive right now. The second issue is inflation, and a related factor, oil prices. Oil prices are feeding into inflation, which was already starting to see some pressures even before oil prices went up. We would need to see inflation and oil pricing come down before we turn more optimistic on India. But India does have one factor going for it, which makes us eager to have the opportunity to go back in. That's that India is a big continental economy with a lot of domestic drivers. It's not an export-driven economy, and in an environment of slower growth in developed markets, that's actually a big positive.
Two key negatives: unusually expensive right now, and inflation and hit on oil prices. Dan, just to clarify, you said Asia, and this is broadly, I'm assuming ex-India, you said can outperform developed markets on the downside. Did I hear that correctly? So you're basically saying that developed markets may fall more and Asian markets can fall lesser.
Yes, correct.
But fall nevertheless. Go on, sorry.
Yes, which is a bit of a departure from historical patterns. Typically, Asia, being an emerging market region, tends to be more volatile than more developed markets. But I think this time around, the story is a bit different. Asia has lower export dependence than it did, say, during the GFC. As I noted, the valuations are there. The earnings cycles are in different parts of the cycle in the US and in Asia. The US is at basically record high margins, whereas in Asia, margins are in the low end of the range, which means that cyclically there's more headroom in Asia than in the US.
The big problem is inflation. How much do you think, roughly, in layman speak, how much of the inflation problem is because of the Russia-Ukraine issue? Is it 30%, 40%, 50%, more than that? And if things change tomorrow, the proverbial tomorrow, will the problem go away or be substantially reduced? I mean, the headache for markets also disappears then. Your thoughts?
Well, it depends on where we're talking about. If we're talking about the U.S., Ukraine is actually a fairly small part of the picture. We had clear inflationary pressures last year before the Ukraine crisis developed in the U.S. Inflation numbers, both headline and core, were already going up last year. Asia, however, is a different story. In Asia, the inflation problem is almost purely driven by commodities rather than demand pool or wage pressures. And in Asia, I think the inflationary pressures could drop off very quickly. Unfortunately, global equities tend to follow the Fed. And if inflationary pressures in the US continue even after a resolution of the Ukraine crisis, if one were to come, the Fed would still be hiking and global equities would still be suffering.
How realistic are these recessionary worries for the US? I mean, I know there is some ground for worry, like the Fed hiking rates, etc. But most economists believe that the odds are against a recession in the US, and these are just fears at the moment. Would you belong to that camp as well?
We think that there's an elevated risk of recession next year. Probably not this year, but we think that the yield curve in the U.S. will invert in 4Q this year, and that typically presages a recession 3 to 6 months down the road, which places us into a recession next year. If we look at Fed rates, that also would imply that we would get into recessionary risk next year, because even with these hikes we've got this year, real rates are still quite low. They're not yet in restrictive territory. The risk of recession comes from two sources. Number one, the Fed, we think, needs to bring growth below trend levels to relieve inflationary pressures. And number two, when you're raising rates as aggressively as the Fed is right now, it's very easy to overshoot on the aggressive side because there's a lag between when you hike rates and when you see the impact.
Well, Dan, you mentioned that the India demand and the growth story is still pretty solid. And you have done a change in your portfolio. I think you all are getting a little bit more positive on Ultratech Cement, and you all have pulled out Infosys. Tell us more about the cement call. Because there are a lot of fears out there, additional supply, input cost spiking. But you believe that at least for Ultratech Cement, some of these concerns are overdone?
Well, let me focus on our top-down considerations when we're choosing stocks in general rather than getting into the weeds of these individual stocks. We are focusing more on domestic demand plays right now and much less on export plays. This is very simple. We've got an outlook for considerably slower demand in developed markets, and that means we should be shifting inwards towards domestic stocks.
Okay, inward towards domestic stocks. And I mean, you did mention that for a market like India, which is not export dependent, very much a domestic driven economy, longer term it kind of bodes well. Dan, just to kind of pull back a little bit, what can change in the US, you think? President Biden's approval ratings are, according to some, dropping faster than the S&P. Inflation is a problem, but falling growth, etc., maybe 2 quarters down the line will be a bigger problem. So wouldn't that force the White House and then the Fed to pivot a little bit to supporting growth? Just thoughts on that.
Well, at some point, the Fed is going to have to pivot towards supporting growth if growth does, in fact, come down as the Fed wants it to. But the point is that in the near term, the Fed needs to bring growth below trend levels to lower inflationary pressures. And that means higher unemployment, which will be politically difficult. But we think the Fed has no choice in the matter.
You started the conversation by saying that Asia may not fall as badly as the developed markets for the rest of the year. Within that, now what should one do in a market like India? Is this a time to be putting some money to work at least, or not quite yet?
I'd be hard-pressed to tell people to be aggressive in buying equities anywhere right now. Right now, we're more focused on defensive places, places to hide, rather than looking for places to make money. There will be money made on individual stocks, but I think it broadly speaking, globally, the second half of this year is going to be difficult from absolute performance perspectives.
All right, Dan, you were talking more about domestic themes, and so cement came up. What about in India? Auto themes. There is some optimism out there, at least in the recent past. They've done relatively better in this falling market. Any view on that?
On autos, well, I think autos are interesting in the sense that you've got underlying demand and you have some easing of the chip shortage. But potentially the construction story is more interesting in India. In India, we think that you've got a property sector cycle that's going to get started soon, and that would drive construction materials.
We've had a cycle for the last 1.5 years. Maybe it'll get stronger, hopefully. And of course, I mean, that's such a large area that it's got so many implications on other sectors as well, materials, etc., as you pointed out as well. Dan, just a quick word on the other argument that we've heard from many who've come on the program, that eventually, once the dust settles with this inflation fight, etc., and we get to some kind of equilibrium, equities have adjusted to the new normal. Do you think markets like India will find themselves in a stronger position from a foreign inflow perspective? The reason I'm putting that is because we've heard others say that China, to many large global investors, is becoming, I mean, it's a harsh word, but uninvestable. So people don't want to. And many other places around the world have, in a way, blown up. So does that kind of put India in an advantageous position some way down the road? Any thoughts?
Yeah, I do think that India is going to be an attractive place for foreign investors over the long run. It's got good structural growth. We like the industrialization strategy for India. It's already showing signs of succeeding. We like the IT services sector as a driver. We like the demographics. The corporate sector has a lot of breadth that you can get exposure to a wide variety of companies in India. So I do think, aside from the valuations and aside from this short-term issue with inflation and oil prices, that India is in a very attractive place for foreign investors.
Oh, wow. It's nice that you said you like IT, or like on the other end of the camp. You know, the whole world is sort of negative on IT stocks right now in India. But by the way, folks, as they say, the darkest hour is the one before dawn. Just look at what's happening in the Bank Nifty now. It's a sudden recovery that we've seen. The Bank Nifty is now well in the green, up about 100 odd points. And the market is also off its opening lows quite fast, I must say. The Nifty is also threatening to break into the green. So brace yourselves for a volatile ride. Fasten your seatbelts, perhaps. It looks like it's going to be that kind of a choppy day. But Dan, since we're talking about the Bank Nifty and the recovery there, I notice in your Asia strategy report, you're overweight on banks as well, on positive leverage to rates and falling credit costs. Would you extend that to the Indian banks too?
Yeah, certainly. The story on both counts looks good. And within India, we would be overweight the banks. India isn't our favorite market on a 6-month view, but within the market, banks look quite attractive right now.
Okay, all right, Dan, thanks so much for joining, and we hope the next time we chat, maybe there'll be a resolution, in Russia, inflation cools down as well, and then India as well comes into, your more positive side of the markets in terms of your view on the Asian markets. It's been good chatting with you. Thanks so much for joining. And two key risks there for the Indian markets is what Dan points out. One is inflation. The other factor